Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today we are going to be revisiting Ulta Beauty. I've covered this one twice in the past on the channel within the past less than a year, with the last update coming in May. But I had a request over on Patreon for this one, and so I kind of bumped it up to the top of the list. And there have been just a couple small, well, maybe not necessarily small changes, but there have been a couple changes since May when I last made my last video. So as always, this is not individual investing advice. This is just how I analyze stocks, and you can go over on Patreon and join. There's a free tier there and a $5 tier. If you join the $5 tier, you can request any stock that's not in the S&P 500. Ulta is, so I post those on YouTube for free, and then I post all my YouTube videos over on Patreon on the free tier as well, so you can make sure that you get access to those and you don't have to rely on the YouTube algorithm. If I also have a full Cyclical Investors Club service over on Seeking Alpha. So you can check those out. If you join Patreon at the $5 tier, you can get a big discount if you ever decide to join there. I also have a 25% off affiliate link for Fast Graphs down in the description, and we're going to use that quite a bit in this analysis. All right, so let's start by reviewing kind of what I covered last time with Ulta. So the title, I think in the title of that video, I said it was a good relative value for investors. It came out in early May. Let's shorten this time frame on here real quick. Early May, I think it was right after this decline, like right in here somewhere. So, and I thought it was a pretty good relative value. So, but I can't remember if it was right at that buy price or not. But we've had a couple things happen since then. One, earnings at that point in time were expected to be higher than $26 per share. And now they're expected to only be like $23 this year. So earnings expectations have come down. We also got news that Berkshire Hathaway was buying the stock. That's what put a bottom under it right here at 318. Oh yeah, my normal buy price back then, I remember now, was 317 for just using a normal valuation. And then the Recession valuation buy price was 324. So almost right where it put this potentially temporary bottom in, but when the news that Berkshire was coming out. So it was right pretty much in that area. I don't think it had quite gotten down there when I made the video, right? But relative to the S&P 500, I thought it was still a pretty decent value. The price had come down a lot and it wasn't crazy priced. So I've changed two things since then and I am long this stock, by the way. I bought it back in 2020. I think it had a giant jump in the fall of 2020 that we got right before it. Yeah, so right in here. Like we bought like in October, and almost right after we bought it, it had this huge jump and it kind of got close to back to pre-pandemic levels pretty quickly, and I've just been buying and holding it ever since. So, and I've been happy with it. My thesis then was earnings would recover, to treat this like a recession, which it was, a weird one, and then they did recover, and they recovered probably stronger than maybe even I expected. But if you look, they're basically on trend to where they would have been without like COVID at this point in time. So I'm long the stock, and I really haven't had any kind of buy, like quote unquote buy out on it, I don't think, since 2020. So it's just been kind of fairly valued. I think it got pretty close back here in 2022. Maybe if somebody from the Cyclical Investors Club is watching and they did buy it at some point in here, then you can let me know, because I don't remember it becoming a buy, but it might have. And then someone asked me right before Buffett bought here if it was a buy, and I was like, well, get like half a position, because we weren't really quite sure what was going to happen, and the earnings expectations did decline. So the main change that I've made is that I'm now accounting for their debt. My last video, I didn't really do that. In this video, that's the main change. And I'm also assuming a recession, whereas I think in the last video, I mean, I had both metrics there and they were pretty close together, so I didn't really get into it very much. So in this video, I'm going to talk about the potential for a recession now that we see their earnings are declining. Now, some of this could be just normalization after stimulus money and people kind of buying makeup and, you know, getting cleaned up a little bit to go out back to work and in public and stuff during this period. So it could be a normalization, but there's also definitely signs that right now the trajectory, I don't think we're in recession yet across the board, but the current trajectory is toward recession, and then we'll probably start getting Fed cuts, and they're going to try to maybe do what they can to see if they can lessen it or stop it, or, you know, we'll see what happens there. But with the trajectory toward a recession, you want to be prepared ahead of time for it. So you don't buy too soon, right? Or pay too much during this decline, because when earnings decline, I mean, if you look, what was the PE here? Like 18, and now it's only 15, but the stock price fell a lot because earnings, you know, the stock price is down 25% just from there, and that's not the peak, right? Because earnings are falling, and we don't know how far they're going to fall. So the technique I use for this is to go back during, if we just assume like a recession, some kind of recession is coming, we don't know how deep it's necessarily going to be. What I like to do is go back to previous recessions and see how the stock behaved during those recessions and use that as a guide, really to try to get, there's two functions that it serves. One is to prevent from buying too soon, like in this declining phase. Because if earnings fall more, which they totally could, the stock price could still go down farther. We're kind of just at the beginning, potentially, of this earnings growth decline. And so you want to be careful not to buy, like if you look here, like a 21 PE, that was actually probably cheaper or the same as the S&P 500 at that time. But, you know, the stock is down how much? Like 35% or something off its high already. And the S&P is not down 35% off its high. So, and that's because these earnings are in decline. So the market starts extrapolating this down, and if it goes into year two, then the market will probably get even more negative. So one of the things the recession PE does is if you're using it, like I explained in the last video, you know, my buy price at that time was 324 for the recession PE, right? And we weren't, if it came out in early May, which I think is when it did, it wasn't quite there yet. So even though, you know, people start asking me about it during the decline, it's like, well, if the market prices it like a recession, it's not close yet, right? So the way I do that, now we don't really have great recession data, even though this 2009 we have data, because we don't know where earnings were before 2009, right? We really want to go back to like 2006, and then we can see how much earnings fell during this recession. So we don't really know what the peak earnings would have been for them, but they were kind of in like a growth phase. So it's possible, I'm going to take a look at it just as a reference. But mostly my calculations are based on this 2020 decline, because the market really priced in quite a bit of bad news pretty quickly for Ulta. They came off a pretty high PE of 30, right? And then fell like 60, at least 60%. So this does look to me like the market was pretty negative on the stock. And so that's going to be my guide here. And it's just a guide. It's not like an exact science. You just want to not be buying like here, right? At 450, because the stock fell 20% or something. Because, you know, if you just from there down to when this previous trough, you already lost 30%. We aren't even in a recession yet. So initially the recession PE stops you from paying too much too soon for something if we think there's going to be like a recession. So the way this works is I take the peak earnings, which is 1215, because what happens is when these earnings decline like they did in COVID and like they are right now, The market looks more and more forward at the trajectory of falling earnings and sends the stock price in that direction using these falling earnings. And you don't really, the assumption that I'm making is that because it's a cyclical decline, eventually the business will recover from that. Now, it might take a couple years. It only took, because we had so much stimulus, it only took 1 year last time. But it could take 3 years, right? We could have 2 years of decline in earnings, and then 3 years to get back to 2024. And that's kind of what I have like roughly in mind. But it can take all kinds of different forms. But that's kind of the standard way to think about it, I would say. So I take the peak earnings and the trough price, and I create a PE ratio out of that. And I think this one is going to be, well, you can kind of see 124 divided by 1215 is going to be a little over a 10 PE, which is pretty low for this recession PE. So what I can do is I can go over, and now that earnings have fallen, I know the peak price is 26.03. And what I want to know is how far would the stock have to fall to create this same recession PE that it created back here. And then usually what I do is, depending on how low that recession PE is, I add a buffer to it. Like in this case, I use 30%. So instead of a 10 PE, it's going to be like 13 something. We can discuss and think about whether that's appropriate in a given situation, and there's like leeway there. But the idea is you don't want to miss out. Like, let's say, so the recession PE before I made the debt adjustment was 324, which is something that I just did recently. So let's say this really was the bottom. 318 was the bottom. Well, if I didn't and people like Berkshire Hathaway came in and started buying, and there are other hedge fund managers and activist investors who announce what they're buying or who have to report it in 13Fs. And so many times a stock will be close to like my buy price, and these guys it'll get announced that they were buyers, and that will be enough to put a bottom under a stock, and then I never get a chance to buy it. So if this ended up being the bottom, this would be a case where if I was using a 10 something PE for my recession PE, and I didn't add like a 30% buffer to it, I would miss out completely, right? So that's the thinking behind it, is getting down to the exact bottom of some. It's not an exact science, it's just an estimate. And what we want to do is avoid buying way too soon and get somewhat close to the bottom, or at least not even close to the bottom as so much as somewhat at a price where a recovery will produce very good returns for us. Like in this case, I didn't even buy Ulta near the bottom. I bought it when it started to kind of recover. I think when I was just looking through, and it looked like this was going to be, once COVID was over in 2 or 3 years. We didn't even have the vaccines in October yet. It was announced after that. I just thought, look, this is going to burn out in 2 years. We'll get back to normal. And at this price, using this earnings assumption, it was cheap. Right? So, same kind of thinking applies. So that's the reason for the buffer. But it can also mean that you have to sit through bigger declines. If earnings keep falling next year, then you bought it at 324, then it could fall to like 250 or something. I don't know where it was back here. Like 3 going into. So yeah, it could fall to 250 in a recession if we have another year of bad earnings. But it should recover eventually. But that you just you were farther away from the bottom, and you have to sit through a deeper decline. So for a further reference on the recessions, we can at least go back and take a peek and see. Let's assume it looks like earnings were kind of flat this year, so I don't know what they were that year. But we have 43 cents in earnings. We have a bottom price of $4.11, right? Again, that's a little over a 10 PE, recession PE. If they were growing through all this, and they probably were, given the growth rate that they have going on here. So they probably were growing, that we might be able to just say, hey, that probably is a recession PE there. Again, 10 something, right in the range of the 2021. So we have kind of some confirming evidence. Even though this was a long time ago, they were a smaller company. They were able to grow more than. They're not going to have the same kind of growth prospects going forward. And all that context, when you combine that data together with the 2020 data, which was only 4 years ago, 4 or 5 years ago now, we can kind of get some confidence that, look, that's a decent estimate to make, right? So what price does that come out to? Oh, the other adjustment change I made was I did adjust for some of the difference between the market cap and the total enterprise value is slightly more. So I adjusted for that in the stock price a little bit. It didn't make too much difference. I think it's like 10% lower than it was before. All right. So if I get my spreadsheet to load properly, yay. So here's where we're at. Using the recession PE, including the extra debt, we're looking at basically 294, which is about 21% lower than where it is now, to buy using a recession PE assumption. Now, if you use kind of the standard valuation, which I had in the first video, which I still calculate here, I only assume they grow earnings 7% off going forward, which is pretty low, but I mean, they are kind of everywhere, it seems like. This was in the 6-ish% 10-year CAGR range, and now it's gotten worse, and that's because earnings have gone down. So the base that it starts from is lower. This is still better than most of the stocks in the S&P 500. I mean, that's probably what Berkshire's looking at, especially when they bought a little bit lower. And then, of course, if they surprise on this earnings somehow, I mean, they've definitely grown faster than that historically. I mean, going into even the year before COVID, they grew 11%. And, the last year they grew 8%. So those are both higher than, my 7% assumption. And then the lower this gets, the more likely it is that the growth off of this, once ever we get out of the weakness or the COVID bust or the recession or whatever, is probably going to be, higher. So, I mean, I might even be conservative on that, but I would say there's a good chance it could be exceeded. I mean, it's not crazy to think that earnings fall 10% more, 20% more, or whatever, and then off that they can grow at like 12% for the next 10 years probably, off whatever that ends up being at, and that's not like a stretch really. So it could end up doing a lot better, and so that's kind of my thoughts there. But yeah, assuming now, one thing we can look at is, I told you I have that 30% buffer. So 10.25 is the PE, is the recession PE. So I have a 30% increase on that, which brings it up to like 13 something. I can actually look and see what it was if we just don't want a buffer. Like if you really want to try to bottom pick a recession price, we can do that too. And that would be $226 per share, about 40% lower than where it is right now. So if you want to be more conservative, if you want to layer in, maybe you can use that as a guide. And then, of course, the timing on this is going to be really hard to know. I would say, yeah, I mean, if somebody, really made me make a prediction or an estimate, I think next year earnings could fall for a lot of companies too. Maybe not a ton, who knows how much, but if the expectation is real for a lot of, I think the S&P 500, the earnings growth expectation is 14% for next year, which I think is kind of nuts. Unless we have more inflation, and lower interest rates really like juice the economy somehow, maybe via housing. I mean, I don't know. It's hard to quite imagine how it would happen. Government stimulus, I guess, could happen. But minus more government stimulus, I would say, this year is going to be slow. Next year is going to probably be down a little bit more, and then we'll probably start to form some kind of recovery, all other things being equal, and that will have us. And the recovery might not be strong necessarily, but that would take us from 2022 on a 5-year period of basically digesting all the stimulus money and all the things, and you know, geopolitics, and with the wars and trade policy and so forth. That would give a kind of 5-year digestion period for every, and then the housing market's totally frozen basically. Commercial real estate is still, a mess. So that's kind of the minimum period I think we have kind of to digest all this stuff. And then, depending on what happens in the world and what kind of policies we have and how people decide to go with it, we could probably start getting some growth out of that. But if we screw things up, it could be another 5 years. So, but generally speaking, with a business like Ulta, I think this year probably weak, next year probably weak, and then we start to see some growth. So I would hope that in like 5 years, we're a person who was buying around what that, let's just call it like $300 level, this kind of level down around there, give or take like $20 up or down, should be doing pretty good, I think, in 3 years, and then some chance for some really good returns in like 4 or 5. So that would be kind of like my base case. All right, I know this was like an unusual one, but it's kind of an unusual case to some degree. Hopefully you found it useful. If you did, hit the like button, hit the subscribe button. Make sure to check out Patreon. You can always start out on the free tier over there. I'm going to be adding more and more stuff over there. So thanks for watching. I'll see everybody later.